Hey, welcome back to the Consulting Mind. Today, we're going to talk about the changes of the Fed balance sheet regarding the recent SVB banking crisis, and we are also going to highlight some key implications about the changes. So first, let's talk about the changes of the Fed balance sheet in recent years. As you can see, early on in 2020, the Fed has been expanding its balance sheet to counter the effect brought by the COVID-19. So the balance sheet numbers go from about 4 trillion US dollar to the peak of 8.9 trillion US dollar in 2022. And then the Fed has announced the plan to trim down its balance sheet since September of 2022. As you can see, the Fed spent about a year to trim down its balance sheet from 8.9 to 8.3 trillion US dollar at a magnitude of close to 600 billion US dollar. The initial plan was to cut the balance sheet at the level of 95 billion per month since September 2022. And then we can take a closer look and to see what happened with the Fed balance sheet in March this year. Due to the SVB banking crisis and the subsequent liquidity needs, the Fed has expanded its balance sheet again in March. It only took about 2 weeks for the Fed balance sheet to expand it by about 400 billion US dollar, which is almost two-thirds of the tapering scale made in last year. So the Fed balance sheet has back to the level of 8.7 trillion US dollar again in end of March. So then we can take a look about how the 400 billion US dollar was spent and was spent to whom. So basically, the Fed has expanded the balance sheet with four key tools as summarized below, and we are going to go through it one by one, which include the other credit extension facility, the bank term funding program, which is also known as the BTFP program, the discount window, the traditional one, and the last one, foreign and international monetary authorities, which is a FEMA repo facility. So these four tools basically share one thing in common. They both appear in the asset side of the Fed balance sheet, and they are both belong to the short-term nature instead of a long-term nature. So let's start with the other credit extension. It worth about close to 118 billion US dollar as of the end of this month. So these are the loans that are extended to the depository institution that are established by the Federal Deposit Insurance Corporation, which is also known as the FDIC. And this kind of loans are basically secured by collateral, and the FDIC provide repayment guarantees about that. So this kind of other credit extension has appeared before earlier in 2008 financial crisis, where this kind of emergency credits has been provided to bear stand. And there is one implication about this kind of loans, which is this amount of 118 billion US dollars should have been kept at this level, unless there are more bank like SVB has been collapsed or close to level of collapse. Otherwise, if the banking crisis is to be resolved and if the liquidity has been needs, the other credit extension should stay at the current level thereafter. Then we can move on to the next tool, which is the Bank Term Funding Program, also known as the BTFP. It worth about 54 billion US dollar as of the end of this month. So basically, this will provide to those US federally insured depository institution, including bank, saving association, or credit union. The lending rate of this program will be the 1-year overnight index swap rate plus 10 basis points, and the rate will be fixed for the term of the advance on the day the advance is made. And for the collateral valuation, the collateral valuation will be par value and margin will be 100% of par value. So basically, this was the tool that is created by the Fed in response to the bank runs that caused Signature Bank and Silicon Valley Bank to fail, in order to provide and inject sufficient liquidity to those banks in need. And basically, the loans was intended to be conducted for about a year with collateral. And there are some key implications there. According to JP Morgan, that the largest banks are unlikely to tap in the program because actually during the banking liquidity crisis, uh, the the money and the deposit has been actually flooded from the small or mid caps bank to the large bank. So basically, the large bank will have sufficient liquidity, but the small mid bank will run out of cash and deposit. And JP Morgan estimate that the maximum usage of these two can be close to 2 trillion US dollar if needed. So the next one is the more traditional one, which is also the discount window. Basically, it is a central bank lending facility tool, which is meant to help those commercial banks to manage their short-term liquidity needs. So for banks that are unable to borrow from other banks in the Fed funds market, may borrow directly from the central bank discount window, paying the federal discount rate. This tool has been peaked at the level during 2008 and 2009 financial crisis at about 110 billion US dollar. Before the collapse, the central bank primary lending facility, also known as the discount window, has been all but deserted by bank because borrowing from the discount window will send a signal to the market that the bank are in need and is desperately need the short-term liquidity, which is also regarded and perceived by the market that it is a sign of weakness. So basically, the bank will hesitate to use the facility unless it is really needed. So basically, the resurgence and the shoot up of the usage of this discount window send us a very clear signal that the market and the bank are actually under very strong pressure. So again, if the banking crisis is to be resolved, the discount window usage has been dropped gradually. So let's talk about the final one, the FEMA repo facility. It amounts close to 50 billion US dollar as of March this year. And basically, these were the loans provided to the foreign central bank and other foreign monetary authorities. Like when there are liquidity needs or when there are strong need of US dollar by those foreign banks like Credit Suisse or Deutsche Bank, they will require and demand funding from their local central bank, and as a result, the local central bank will demand the funding from the foreign central bank, which is i.e. the Fed. So basically, the facility has been extended from weekly to daily swap in order to provide enough real-time liquidity. So these are how the 400 billion US dollar were being spent in different forms towards different lending program facilities. And if you really want to have a very strong and clear sense about how the crisis is evolving, whether or not the banking crisis is over yet, or actually it is showing a sign of worsening, instead of going through different media or newspaper with different second source, actually you can go directly to the fact balance sheet and to have a first-hand and direct understanding about how the data is going. The data will tell you straight away whether or not the crisis is getting worse or getting better. As mentioned before, if you see any numbers going up or going flat, actually, it already tell you how the story is going to be. So, I hope you like this episode, and if you think it helped you gain better understanding about this banking crisis, please click the like button and share the video for me. See you soon.